Are you looking to get into investing in cryptocurrency? Do you want to find a way to diversify your regular investing portfolio with cryptocurrencies? Do you want to invest in cryptocurrencies without taking a ride on the roller coaster that a lot of tokens and coins have been going on lately? By the time you've been watching, you'll know how to invest in cryptocurrency, both the easy way and the hard way, as well as understanding the possible risks and rewards. So lovingly, tenderly, gently, smash that like button for the YouTube algorithm, and let's get started. Shh, I've got a secret. You're watching Finance Squared, the best channel on all of YouTube for everything personal finance, including discussions on cryptocurrencies like Bitcoin, Polkadot, Cardano, Dogecoin, and more, as well as the companies that are going to be changing the way you spend your money. In case you didn't already know, I'm your host, Derek West. If you want, need the realest personal financial entertainment and information presented in a fun and lighthearted way, be sure to subscribe to the channel and turn on post notifications, because you're not going to want to miss a second of the action. To be a good investor, you need to have solid knowledge of not only the possible upside of your investment, but you should definitely be well versed in the downside you are exposing yourself to as well. Whether you're investing in stocks and bonds, real estate, startups, whatever it is. But that is especially true for cryptocurrency. As a matter of fact, as a rule of thumb, you probably want to be more versed in the risk you're taking than the possible upside. If most investors just avoided the riskiest investments instead of focusing on the highest upsides, fewer people will be making bad bets on things like penny stocks and penny crypto tokens. To understand what the risks are of any investment, you need to understand what it is you are investing in. Are you investing in a commodity, buying gold, silver, copper, wheat, lumber? Are you investing in a company or a group of companies, Tesla, Apple, tech indexes, for example? How are you trying to make money with your investment? Are you trying to capitalize on the difference in price of the asset that you're holding or borrowing in some cases? Are you trying to buy low and sell high and be rich in paper, i.e. fiat currency? Or are you trying to buy and hold and just be rich on paper, high net worth? Each of those tactics and strategies, and many more, has its own risk profiles that you should be aware of. When investing in cryptocurrencies, there are 3 separate strategies that most people are aware of. Buy and hold, frequency trade to profit off the difference in the price of the tokens, and investing in parallel companies that are utilizing cryptocurrencies. The first strategy, buy and hold. This strategy, in my opinion, is shaky both near-term and long-term for a couple of reasons. For example, there are regulatory hurdles that cryptocurrencies face, such as know your customer laws and regulations. These and other financial services regulations were put in place, rightly or wrongly, to help keep track of money movement to disallow for the funding of terrorism and organized criminal activity. The anonymous nature of many digital currencies and cryptocurrencies may sidestep these regulations entirely, causing heartburns for politicians the world over. We know that China has been cracking down hard on certain digital coins like Bitcoin and Dogecoin, and possibly others. Will your local government be next? Now, I am aware that people will still be able to use cryptocurrencies if governments crack down even further. The toothpaste is out of the tube, the cat is out of the bag, the ship has sailed. Insert any other metaphor you can think of concerning lost opportunities. But if governments crack down on cryptocurrencies, that means that their investment potential is severely limited. There's a difference between the stock market and the black market for a reason. One is seen as completely legit and legal to participate in, and the other is for dark transactions that no one should never know about. Then there's environmental concerns. Environmental concerns are a major factor as well. Cryptocurrencies, particularly first wave and many second wave cryptocurrencies, rely on a very power-intensive way of validating transactions. And the way cryptocurrencies validate transactions is simultaneously why most cryptos can be decentralized and secure while not needing third parties like banks or governments. So the mechanism they use to handle transaction validations are fundamental to their very nature. It's the reason why they are called cryptocurrencies and not just digital currencies. It's also why they're electricity intensive. The electricity footprint of Bitcoin has been described as more than that of some medium-sized Nordic nations like Denmark. All of that contributes to the downside risks of investing in cryptocurrencies. Will governments crack down on cryptocurrencies, see point 1, to help to curb the energy utilization of these tokens? It could be, and that is a risk you need to be aware of, particularly if you're going to use the buy and hold strategy. Will cryptocurrency enthusiasts realize this and turn away from holding these coins, affecting their price negatively? They could. And again, it's a risk you need to be aware of when considering investing, particularly using this strategy. Now that said, a lot of third-wave cryptocurrencies are focusing on the energy-intensive nature of their validation mechanism and are designing their tokens to handle this. And some first and second wave currencies are improving their algorithms as well. If all of these things come to fruition, this particular risk could be mitigated, if not completely resolved. By the way, take a look at the video in the card above, where I describe more about the different waves of cryptocurrency. Competition is a risk as well. There's a ton of downside risk to the individual cryptocurrencies and all competitor coins that exist out there. Frankly, I'm amazed that Bitcoin and Ethereum are as highly valued as they are, considering the overwhelming volume of other coins/tokens that exist that do what they do, and do it much better. The reality is, Bitcoin probably has that position because it was the first out of the gate, and the trailblazer always has the advantage over the up-and-comers, even if the new kids on the block are fancier and shinier. That's just one of the quirks of human math psychology. But every now and then, a David beats a Goliath and becomes the new king of the hill. that could happen with all the major coins being traded today. Bitcoin, Litecoin, Ethereum, Chainlink. Each one of them could be beaten by up-and-coming upstarts looking to dethrone the kings. The way it could shake out is that one or two tokens become the tokens that most investors put their money into, the situation that we see today. Or there could be just so many options out there that there are just a sea of coins that all investors are spread out throughout and all over, with no one token being more valuable than another, resulting in a similar situation to what we have in the stock market, with some stocks definitely being more valuable than others, but generally speaking, most people's money is spread out amongst a sea of options. But competitors can affect tokens in another way. In the frenzy to purchase tokens, a lot of people forget that the biggest competitor to Bitcoin, Ethereum, Litecoin, Dogecoin is the yen, yuan, euro, and dollar. Right now, most tokens aren't circulating in the global economy the way fiat currencies are. Most people are simply holding them, hoping that they go higher, or trading them back and forth amongst each other, amongst themselves, hoping to profit out of tiny differences in the price. So the competition with fiat currencies isn't that fierce. And one of the reasons that most coins aren't circulating that much is, in my personal opinion, most tokens and cryptocurrencies couldn't handle the volume of transactions that would occur at the scale of most national currencies. There are a couple out there that can, but you more than likely never heard of them, and they are not trading at the level of Bitcoin, Ethereum, Litecoin, or even Dogecoin. But if these coins ever gain mass utilization to actually conduct daily business with, then they'll be in direct competition with fiat currencies, driving down the value of those currencies exponentially, even more than they already are being driven down. Now, some of you will argue that the stewards of these fiat currencies are doing a good job driving down their value all on their own. That's an excellent argument that at this point I can't argue with. Nevertheless, the stewards of these currencies also control the rule-making bodies of the governments that are issuing these currencies. And if they wanted to, they can make rules to make utilizing these cryptocurrencies illegal. See point number 1, and Google China's crackdown on Bitcoin. Now, the other strategy for making money with cryptocurrencies is to profit off of the differences in the price of individual coins. This strategy is similar in nature to the strategy of Forex, which is a very similar market with very similar goals. That said, there are key differences, however. Let's talk about the similarities first. The first and most obvious similarity between Forex trading and cryptocurrency trading is that you are literally trading currencies back and forth, more or less. Forex, or foreign exchange, is about electronically trading international currencies and currency derivatives. Like cryptocurrencies, there is no central physical trading location for trading these currencies like the New York Stock Exchange. Not an official one anyway. But yet still, the Forex market is one of the largest, most liquid markets in the world by trading volume, with trillions of dollars trading hands every day. Like cryptocurrency, Forex trading can happen 24 hours a day. Cryptocurrency trading and Forex trading have very similar signals that govern their markets. For example, supply and demand. If there are more buyers and sellers for a crypto coin, the price of the coin generally goes up, and so does the price of the fiat currency. Frankly, that's true for stocks and bonds as well. If there are more sellers than buyers, meaning that more people want out of a particular coin or currency, then the price typically goes down. Both markets are keyed into news events, and they can cause massive movements for both. Rumors of wars between nations can cause the price of the nation's currency to fluctuate in relationship to the other nation's currency. Also, news of large buyers of either can cause more people to jump in on the fun. There are significant differences as well that you should pay attention to. Firstly, the crypto market is open 24/7, 365. Anybody can trade any coin at any time. The Forex market is only open 24 hours on a working day. That means many holidays and weekends are times when you can't do any Forex trading. Another key difference to keep in mind is the market size of Forex. The Forex market is one of the top markets in the world for trading volume. That is to say, the number of trades executed. The Bank of International Settlements reported an average of $6.6 trillion of trades in year 2019, which was an almost 30% increase since the last report in April 2016. As of May 2021, the cumulative market cap for the crypto market was about $2.46 trillion, with trading volume significantly lower than Forex at about $540.52 billion. For reference, in 2015, according to the World Bank, $99.7 trillion worth of stocks were traded worldwide. Now, it's come down quite a bit since then, at about $60 trillion. Nevertheless, it is a much bigger market than both Forex and crypto. Now, that might not always be the case, as cryptocurrencies and decentralized finance gain in popularity. And if some of the coins and technology can deliver on some of their promises, stocks may all eventually be crypto anyway. But that's a topic for another day. Like and subscribe. But the difference in volume of trading for Forex and crypto also points to another major difference between the two. I mentioned that about $540 billion worth of crypto is trading hands right now. If that amount of money doubled in the next year, technically that would mean all cryptocurrencies would be worth double the value that they are right now. That kind of volatility is a double-edged sword. It means that there's a large chance of you growing your money by doing nothing except picking a coin and parking money there. It also means that the exact same strategy could result in massive, crippling losses for your wealth. See the last 2 weeks of May for Bitcoin and Ethereum holders, if you doubt what I'm talking about. This can also mean less liquidity, which is a fancy trading term for ease of transactions. You know, if something is liquid, then it's easy to trade because there are plenty of buyers and sellers for that thing. And then, of course, there is the case of anonymity among crypto enthusiasts. In recent years, big cryptos like Bitcoin and Ethereum have eased up on some of their anonymity requirements. but others have not always followed suit, like Monero and Zcash. Forex transactions are among some of the most scrutinized in the financial industry, although there are some companies that avoid and subvert certain regulations and rules, such as Know Your Customer regulations. The risks associated with an arbitrage strategy of investing depends on the deep dive strategy you're using with it. Scalping, for example. Scalping is common to both Forex and crypto trading. That's when you're making many small trades daily or weekly, most likely programmed by a bot to automatically execute trades based off of signals it receives from the source. The risk of the individual trades is rather small if you keep it simple. If you put leverage into the situation, and by leverage I mean borrowing money to invest in cryptocurrency, then that strategy becomes all the more riskier. I did a video on the topic of crypto trading strategies. Please take a look in the video card above. And finally, there's the time-honored strategy of investing in picks and shovels and not gold. In other words, invest in the companies that are enabling other companies to do what they do. That's true for investing in gold or silver. For example, investing in mining companies, refineries, and jewelry companies. It's also true for investing in wheat and wood. For example, investing in agricultural companies and forestry companies, as well as in grocery chains, and food brand companies, as well as furniture makers and even home builders. It's also true for cryptocurrencies. For example, investing in companies like NVIDIA and AMD. While neither deal with cryptocurrencies directly, they're both leading companies when it comes to compute-intensive use cases, like validating transactions. Or Shopify is another example. Shopify has been allowing its merchants to begin accepting crypto tokens as payments for goods and services traded on its platform using crypto payment processors like coin payments. And of course, we must consider Visa and Mastercard as well. Both companies operate global infrastructure that support the large-scale virtual movement of fiat money. And both are laying the groundwork to do the same with digital currencies. The interesting thing about both companies that a lot of people don't know is that neither company issues cards or offers accounts directly, and they don't extend credit, but they both operate dominant networks which move currency of all kinds around the globe from one account to another. In fact, some would argue that they, along with fellow credit card company American Express, are the original cryptocurrencies. But that aside, Visa has already partnered with digital currency exchange Coinbase to issue debit cards linked to digital currency wallets. Mastercard has done the same with BitPay. None of these stocks are pure cryptocurrency investments, which is part of the beauty of them. They help to mitigate the risks that we talked about earlier, allowing for a much smoother investment ride and a very diversified cryptocurrency investment portfolio. Diversify your portfolio of YouTube finance channels by subscribing to this channel and turning on those post notifications so that your personal finance knowledge goes through the roof. And remember, knowledge is power. And be sure to like this video if you liked this video. If you didn't like this video, drop us a strongly worded comment telling us exactly why. Also, comment with your thoughts on the risk of investing in crypto and the ways those risks can be mitigated. Inquiring minds need to know. And remember, a goal without a plan is a wish, and a goal with a plan and no action is a wish list. Take action to mitigate your crypto downside risks by looking into companies that work with crypto and not just buying crypto tokens. And we'll catch you next time. Peace.